The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Fed Chair Jerome Powell opening the door to a September rate cut, suggesting labour market risks may now outweigh inflation concerns.
Powell's comments spark a stock market rally, the Dow seeing a fresh record close after posting its best day in over 3 months. And Dutch coffee group JDE Peet is reportedly the target of an $18 billion takeover bid by Keurig Dr Pepper, with the combined company set to eventually split its drinks and coffee units.
Good morning, how are you?
Very good morning. I'm happy to be back.
Well, yeah, I know you've come back with a cold, for your travels, and that's the problem with flight. But you had a lovely time. I saw some lovely pictures.
Yes.
Great to have you. We've got some deals and we've got massive policy action as well we need to talk about as well. So look, one of your headlines there was just about Keurig Dr Peppers and JDE Peet, and it looks like it has happened as well. So let's just go through the details. Keurig, is that the right way of saying it?
Yeah, I think so.
Keurig Dr Pepper to pay $31.85 per share, 15.7 billion euros for JDE Peet. To acquire JDE Peet and subsequently separate into two independent companies. So coffee will go one side, I presume. The Dr Peppers and the soft drinks will go the other way. A leading refreshment beverage player, there you go, and a global coffee champion. And I've been doing a little bit of work on this one in advance because we thought it was going to happen. And it looks like there's a lot of challenges for both sides of the business as well. Not least the fact that tariffs and concerns about agricultural commodity oscillation and tariffs on those, a bit of an issue as well. They reckon there'll be $400 million in cost synergies expected over 3 years. Do you want to add a quick line on that one before we move on? Or
yeah, in terms of the detail here, they're saying the global headquarters for Global Coffee, which is going to be the new company, will be located in Burlington, Massachusetts, my home area. And its international headquarters will be in Amsterdam, the Netherlands. As far as the beverage company, and you talk about the split between beverage and coffee, beverage company is going to be headquartered in Texas. Those are the details we know so far. And just in terms of Keurig Dr Pepper, this was two companies that came together in 2018, so it hasn't been long since that merger happened, and since then we've seen outperformance of the soft drinks business. The coffee business has underwhelmed, so clearly part of the rationale for this transaction here to try to create a more profitable, a better performing coffee business, and they think JDE Peet's can help them do that.
Yeah, and it looks like the big player behind the scenes is Jab Holdings, which has got a stake in both, controlling, I think, in the acquirer and a minority stake in the acquirer as well. So it looks like they are moving behind the scenes, and they hold a whole host of brands. Okay, brilliant, lovely. Let's get back to the main story. Fed Chair Jerome Powell hinted at a rate cut at the Fed's next meeting in September, telling the Jackson Hole Symposium in Wyoming that economic conditions may warrant adjusting the central bank's policy stance in a weekend where President Trump's threat to sack a Fed governor, Lisa Cook, loomed large.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach.
But Mr. Powell also highlighted the risk of inflation rising again.
Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem.
Got my issues of how the traders reacted, but let's just go with this a moment. Traders appeared to take Powell's comments as indication that a cut is in the pipeline, with the market implied probability of a cut now almost 90%. But it was 100% a couple of weeks ago before the CPI and PPI prints. It was almost 100%. Anyway, okay, let's go with it. It was up from 60 a month ago, according to the CME's Fed Watch tool. But the Fed chair's speech wasn't enough, of course, to placate the president. Mr. Trump has been calling for looser monetary policy for months. Trump said Powell should have cut a year ago, accusing him of being too late. Now, the Fed has cut rates by 4 percentage points since last year's Jackson Hole event. But the problem here I have, Juliana, and you can help me with this one as well, is the market rallied gangbusters on Friday. Really big rallies on the equities, which got us into positive territory pretty much for the week as well. But the market already pretty much knew there was going to be a rate cut. It thought it knew there was going to be a rate cut in September. So I'm wondering if the rally can be justified by actually what it thinks now is the Fed's medium-term outlook, the process potentially of having more rate cuts rather than just that September cut.
I think you've hit the nail on the head, Steve, in terms of where the debate lies now. How far is the Fed going to go? How stimulative do they think they need to be in terms of their rate cutting path from here? I think investors had also expected the Jackson Hole speech to be a somewhat dull event, and that's part of why we saw the strong market reaction. Speaking of the market reaction, here you have it. All three of the major indices stateside gained more than 1.5%. The tech-heavy NASDAQ gained 1.9%, ending what had been a pretty rough week for U.S. stocks on a high note. In terms of the best performing sectors, on Friday, we saw a strong bid for the more cyclical parts of the market. Consumer discretionary doing very well. Discretionary as a basket up more than 3%. Energy also catching a strong bid. Tends to be, of course, a more cyclical sector. Communication services up 1.9% and materials up 1.7%. We also saw a strong reaction in the dollar, with it dropping sharply on the back of that speech. We saw a strong rally in the euro versus the greenback. It rose about 1%. Now this morning, you've got euro fading slightly versus the dollar. Sterling also slightly on the back foot. Dollar yen trading firmly, as is the dollar Swissy. In terms of Asian markets overnight, we've seen strong performance there. A positive handover from the U.S. on Friday, no doubt helping sentiment. We've also seen quite a strong bid for Chinese property stocks amid growing expectations of more stimulus, more policy support there. Shanghai also easing some home buying rules in the last day or so. So the Hang Seng up about 2%, the Shanghai Composite up 0.8%. As for European stocks, here's the early indication of how Europe's poised to open. A different picture here. We're looking at a modest pullback at the moment. The Xetra DAX, the CAC 40, and the FTSE MIB all looking at weaker starts. Of course, it is a bank holiday here in the UK. That's why you're not seeing the FTSE 100 on your screen.
Just seeing some flashes from UniCredit as well. I'll get back to that story about the markets, but it's just fascinating the pressure that UniCredit continues to put on the German banking sector, of course, with its very large Commerzbank state. It says it's converting its shares, part of its synthetic position, into shares, part of the synthetic position as well, through the derivatives market, and increasing its voting rights to around 26%. There's a lot in there. I won't go into too much about it now, but it says return on the investment in Commerzbank is confirmed at around 20%. I presume the word from the German banking sector will be thank you to UniCredit's management this morning. I bet they're not going to say that, though. But they should be thanking them, because they've all done pretty well since UniCredit took that stake as well and galvanised activity in the German banking sector. Anyway, moving on back to the Jackson Hole story. Economists at Barclays, BNP and Deutsche Bank were amongst those who brought their Fed cuts forecast forward to September. Where were they? We were already at 85% before the speech. Anyway, in a note, Barclays said it thinks the 85% cut probability implied by the market pricing is fair, after Powell sent the clearest signal yet that the Fed is leaning towards a cut. But the bank said the tenor of Powell's statement leaves the door slightly ajar for a September hold. Deutsche Bank took Powell's comments as a reasonably strong signal that he's leaning towards a 25 basis point cut in September. The lender also highlighted what it saw as increased concern about the labour market picture in his speech. Meanwhile, Goldman Sachs saw Powell's speech as consistent with its already held view that the FOMC will cut rates in September. But there remain signs of division amongst Fed policymakers. Chicago Fed President Austin Goolsbee told Bloomberg that high services inflation in last month's CPI reading made it a, quote, dangerous data point. And speaking to CNBC, Cleveland Fed President Beth Hammack signaled inflation remains her main concern.
We'll see inflation continue to rise. We may see unemployment continue to rise as well. And that's a challenging moment for monetary policy to think about what the right way to balance things. For me, what the decision really comes down to is that inflation is too high. It's been trending higher. It puts a real pinch on lower income households. We've been above our target for 4 years, and we need to get that under control.
Speaking to CNBC, the former Cleveland Fed President Loretta Mester spelled out the central bank's tricky balancing act and said upcoming decisions would likely not be unanimous.
They have to be careful because they can't give up the fight on the inflation. Inflation is going to be moving up higher. Yes, their interpretation is those are one-ofs, but they're one-ofs only if the Fed does the right thing with monetary policy.
Let's get to John Plassard, who is partner and head of investment strategy at Sept Gestion. John, lovely to see you. Not for the first time, despite being around for a long time. I'm mildly confused. The market already was pricing in 100% possibility of a cut in September before the inflation data, 85% after the data. Now the laggards are coming back to 85%. So we think that's done. But as far as the October decision is concerned and the December decision is concerned, which is October 28th, 29th, December 9th and 10th, I don't know, given what Loretta Mester just said and given everything that Jay Powell also said, how can the market be so sure that a longer-term rate-cutting path is on board rather than just one and done for now?
So, Steve, because, historically, the Fed, when they cut, they start a cycle of cutting. So I think 25 basis points is not enough. But let's make it clear here. I think that the Fed actually standing on the verge of a monumental policy mistake. And I think they will cut in September. And I think this is a mistake. Because the inflation that you just mentioned it still runs well above the Fed's mandate. It's 4% on average since the COVID. Producer prices are skyrocketing in the US. There is a risk, and Mr. Powell just mentioned it on Friday, of a rapid unemployment spike. Everything is at record high. Housing in the US, money supply, debt, national debt, stock, etc., etc. Why will a central bank and the Fed cut the rates now when there are so much uncertainty? So here is my call. They will cut in September, but I think it's a mistake, and even it could be the biggest mistake they have done since the famous, if I can say that, policy mistake they did in 2022 with this transitory inflation. Things are not clear enough to cut the rates.
I hear what you're saying, and I have a great deal of sympathy for it, but the traffic is going one way. We don't even know what's going to happen with voting member Cook at the moment as well. What I'm more worried about is Katie Martin's piece in the FT today, which we're all thinking about. We're all thinking about it before it, but she's put it in one very succinct headline: brace for the Fed's MAGA takeover, or makeover, I should say. So the traffic in terms of the new governor when we get it, or the chair of the Federal Reserve and other governors, is going to be one way. It's going to be about more aggressive rate cutting. And given everything you've said about you think this one would be a mistake, how bad could this get?
It could. I still think that the Fed is independent, even if Mr. Trump is putting pressure on Jerome Powell. And, Mr. Powell is not the only one to take decisions. And even if he wants to fire Lisa Cook, there are 12 members that are voting. And I really don't think that this pressure is something we have to look at actually. Otherwise, that could be a very wrong message to the market. And one of the Fed members last Friday said that historically there has always been pressure on all the members if the president, the US president, was disagree with the decisions. The difference actually is that Mr. Trump is saying it out loud. Historically, it was more, calling them or not saying anything on the news, and this is different. But I still believe and I still hope that the Fed is independent. And you just mentioned it before. You have lots of Fed members that are against rate cut in September, some hawks, some doves, and so many question marks. And just if I can come back, Steve, on the fact that when talking about the labor market, and the labor market is really something, even if Mr. Trump is telling, Mr. Powell is looking at inflation, but the labor market is in a curious balance. Okay, so this word is very important because it means that we don't have clarity about the future. And if you don't have clarity, you don't cut the rates. That's my view.
But ultimately, we did see Jerome Powell strike that more dovish tone, suggesting that we are going to get a rate cut. What do you think changed for him between the last time he addressed the market and the press conference at the meeting when he was much more reticent to talk about a need for a policy change and now?
That's a very good question, Julia, because, if I look at the Fed minute last week, they said that they will focus more on inflation, more than unemployment rate. And Mr. Powell said exactly the opposite on Friday. So I think there are really strong internal division at the Fed. I don't think, and this is, usually it's not the case. So I think that the sky is not as clear as it is expected. And at some point, the investors, let's say, if the PCE, the inflation next Friday is well above what is expected, I think that this 87% probability of cut in September will shift under 50% because the message, once again, I think it's a wrong message that is given to the market actually.
But interesting that the market rallied quite hard on Friday in reaction to the speech. And when you hear, I'm listening to you say that if they do cut rates, it's going to be a massive policy mistake. What do you think the markets are missing here? We saw this massive turnaround in equities. We saw the dollar come down. Just talk to us about what you think that discrepancy is down to.
I think the message were more dovish than expected. Everybody was expecting Mr. Powell to talk about the data dependency that he's using, and I think it's not wrong. But he was well more dovish and really opens the door to the rate cut. And we know that what is said at Jackson Hole historically is something that is done just after at the next meeting, so in September. So I think that the message was much more dovish than expected, even if we were expecting a dovish tone, but more on the data dependency side. So this is what changed, and this is why the market, skyrocketed and the dollar went south.
It's interesting to hear you talk about the change in tone around data dependency because Scott Bessent a couple weeks back was saying that he thinks that the Fed is becoming old-fashioned in talking and emphasizing its data dependence and should be much more forward-thinking. Is there merit to that view, do you think, that the Fed should let go a little bit of this data dependency mentality and adopt a more forward-thinking mentality, whatever that means?
No, because actually forward, the forward view of the monetary policy in the US is something very difficult to clarify, because if you look at the anticipation, the inflation anticipation and the unemployment rate anticipation is higher. So I would say let's look forward. If you look forward, you don't cut the rates. So this is why I think you have to stick to this data dependency. actually, and I just repeat what I said before, I think there are too many internal divisions. And maybe, I don't think it's the case, but maybe the political pressure from Mr. Trump is going the right way for him. But this would be terrible for the market.
Yes, and that, John, is exactly my last question. How terrible for the market? And how do our viewers and your clients prepare for that?
So this is and we spoke about that last time, Steve. This is what I call diversification, the 3D, diversification, diversification, diversification. Even if everybody thinks the sky is blue, you need also to have a diversified portfolio with gold, with pharmaceutical, really something that we didn't have last year, because last year, if you had just an ETF on the S&P 500, you were the king of the world. And I think it's totally different, actually, even if the Dow Jones is at record high, the S&P close to it, etc. You really have to manage the second part of the year with much more volatility. So, if I look at the SWOT analysis of the market, the worst thing that could happen is a policy mistake. And I think we're not close. We're not so close to it. We're not so far to it. We're close to a policy mistake if they cut in September and maybe not in December.
John, we love speaking to you, and thank you very much indeed for a word of caution from Mr. Plassard today for our viewers as well out of Geneva. Lovely, sir. Thank you. John Plassard, who is partner, head of investment strategy at Cité Gestion. Thank you, sir. Coming up on the show, Fitch affirms its UK credit rating. Well, at least something's going right. We're going to dive into the factors affecting its outlook for the UK. Plus, big, hot and fresh I see what you did there. Yes, very good. In the M&A space, Keurig Dr Pepper confirms it will buy Dutch coffee brand JDE Peet. And we're going to get the latest health check on the German economy. The IFO President Clemens Fuß joins us exclusively at 9 a.m. London time to break down the latest economic data. Welcome back. Former ECB President Mario Draghi says Europe has faced a brutal wake-up call from the US President Donald Trump, warning the continent is ill-equipped in navigating the current global trade environment. Draghi called for the EU to lower internal barriers. Can I say again? Yes, he called them to lower internal barriers. Again, come on, guys, he's saying, and issue common debt. That's contentious. To increase expenditure on the likes of defence, R&D and technology. Bring up rhymes. Speaking at the Fed's Jackson Hole Symposium, the ECB president, the current one, Christine Lagarde, said Europe's labour market is in, quote, unexpectedly good shape after recent economic shocks. Lagarde also pointed to benefits from an influx of foreign workers, saying that without them, labour market conditions could be tighter and output lower. Now, speaking to Fox News, Madame Lagarde addressed the need for central bank independence and President Trump's pressure campaign on the Fed.
I think the independence of any central bank is critically important. I think we have to be accountable. We have to report back and to answer all the questions of either Congress in the US or the European Parliament for me. But it's vitally important that central bank is independent.
OK, back to Blighty. The Bank of England Governor Andrew Bailey sounded a warning over what he called the acute challenge facing the British economy. Yes, you guessed it. It's anemic growth. In fact, that's just one of the problems. I could think of 5 more. And reduced labour force participation. That's number 2. How about productivity? Number 3. Anyway, we'll move on. This, as official data indicates, around 1 in 5 Britons aged 16 to 64. Wow. I'm going to say this again. 1 in 5 Britons aged 16 to 64, wait for it, are neither in work nor looking for it. What the heck? Fitch has maintained its UK credit rating at AA- with a stable outlook. The agency said it expects growth to remain subdued amid a cooling labour market. global uncertainty and weaker external demand. An economist has claimed that the UK's present financial situation is as perilous as the run-up to when the country was forced to seek a bailout from the IMF in 1976. As a lack of investor confidence sends borrowing costs even higher, with gilts now yielding more than Greek debt. Professor at Cambridge, Jajit Chadha, told The Telegraph the country's economy is at risk of collapse, with the need for a possible bailout very much on the cards. Well, he's gone for it, hasn't he? So I don't know if that's the case. I know things are tough. I also know that The Telegraph comes from a political constituency which wants to bash absolutely everything the government is doing, and quite rightly so in many cases. The government has made some pretty big mistakes as well, but I am also very conscious of when I see an economist talking about 1970s bailouts and collapses being quoted in The Telegraph. We have to take that as knowing where it's coming from.
Yeah, that's an important context for sure. My eyes jumped out at the same thing that you. I think you were in awe of the stats around.
No, I wasn't. I was in utter horror.
Around this labor force participation of 16 to 64-year-olds in the UK. This point that Andrew Bailey made, that data shows that the percentage of 16 to 64-year-olds active in the UK's labor market is lower than before COVID, unlike in other advanced economies. And mental health, this is interesting color, and Andrew Bailey alluded to this. Mental health was the most common reason for being inactive, a point that Bailey described as a very concerning development. So he says now the Bank of England, they're a little bit less focused on long-term trends in unemployment, and they're instead focused on these levels of labor force participation.
I get why mental health should be looked at in a similar vein to physical health. I don't think companies, I don't think employers, I don't think as a society, as a planet, we have spent enough time considering mental health. That said, why is it, and this is what I want to know, why is it that the British mental health situation is apparently so much worse than the global or the rest of the Western world? Now, is there something specific about the UK? I very much doubt it. Or is it also to do with the fact that the amount of benefit available to people who do suffer mental health issues as well is perhaps more generous and is less rigorous in its measuring in this country than other countries? Trust me, I get mental health issues as well. I have a wife who's a practitioner in the place. I've had people I know very, very well and dear friends and family who have suffered from it. So I'm not negating it. I just think there are certain factors in the UK that may be at play that institutionally we are treating in a different way from other countries.
It's a really interesting point, and I think key here that the UK is having a bigger problem than other advanced economies.